Welcome to the Thrive in China podcast with me, Christina Kohler-Coluccia from Woodburn Accountants and Advisors. Our daily episodes on solving your China and Hong Kong business pain points are there to help leaders, managers, and entrepreneurs with the daily struggles they may be facing while setting up and operating in China and/or Hong Kong. We look at corporate administrative battles such as tax planning, incorporation, accounting, human resource, and labor, as well as cultural and language nuances that may make a daily business life hard. Our goal is to leave you with solutions at your fingertips. I hope you enjoy the episode.
Welcome back to another episode. Today we're going to be looking at what are the tax considerations when choosing a location in China. As we are aware, when choosing a location in China for business operations, there are several tax considerations or tax implications that have to be kept in mind. Now, China imposes a corporate income tax on the worldwide income of resident enterprises and the China source income of non-resident enterprises. The standard corporate income tax rate is 25%, although there are certain industries and regions that may qualify for preferential tax rates or incentives. VAT is levied on the sale of goods, the provision of processing, repairing, replacement services, and the importation of goods and intangible assets in China. And the VAT rate varies depending on the type of goods or services, with rates from 0 to 13%. China also imposes withholding tax on various types of payments made to non-resident enterprises, i.e. companies abroad, including dividends, interest, royalties, and service fees. Well, withholding tax rates may vary depending on tax treaties between China and the recipient's country of residence. Import and export activities in China are subject to customs duty, which vary depending on the type of goods, their origin, and any applicable trade agreements or exemptions. Different regions in China may offer tax incentives and preferential policies to attract foreign investment and promote economic development. These incentives may include reduced corporate income tax rates, tax holidays, exemptions, subsidies for eligible businesses, as well as tax rebates. China has transfer pricing regulations that require related party transactions to be conducted at arm's length prices. Companies operating in China must comply with transfer pricing documentation requirements and adhere to transfer pricing methodologies endorsed by the Chinese tax authorities. Employers in China are responsible for withholding and remitting individual income tax on behalf of their employees. The tax rates and thresholds may vary depending on the individual's residency status, income level, and other factors. Businesses operating in China must comply with tax reporting requirements, including filing annual tax returns, maintaining proper accounting records, and submitting relevant documentation to the tax authorities in a timely manner. And this, again, may vary depending on the location that you're in. China has entered into double taxation treaties with many countries to prevent double taxation and provide relief for cross-border transactions. Again, businesses need to consider the implications of these tax treaties when structuring their operations in China and engaging in international transactions. Last but not least, in order to be able to benefit from certain tax incentives, tax holidays, tax rebates, businesses really need to engage in tax planning in order to be able to optimize strategies to minimize their tax liabilities. The idea is not tax evasion, it is ensuring that the company is in compliance with the Chinese tax laws and regulations. This may involve structuring transactions efficiently, utilizing available tax incentives, and managing transfer pricing risks. Now, when you are choosing a location in China, there are three things that are really important to understand. Each city in China is made up of districts. When you choose an office space, remembering that you are registering your company in that city, and I want to use Shanghai as an example, you are registering your company in Shanghai, but you are registering your tax status within that district in the city. So I'll give you an example. If your registered office address is in Huangpu District, you are registering with the Huangpu District Tax Bureau. It goes that much into the intricacies. So if you want to have a better understanding, there are 8, 9, 10, 11, 12, 13, 14, 15, around 15 districts in China. Each district has its own tax bureau, and each of these tax bureaus has its own nuances of working. There are some districts where there are fewer foreign investors, other districts where there are more, and hence the experience and the level of ability to negotiate with your tax officers can vary dramatically in Shanghai alone. To give you an example, Fengshan district has very few foreign investors located there. However, if you start locating yourself in Jing'an district, which is really the center, CBD area of Shanghai, then you know that you're going to be working with tax officers that are very familiar on the laws and regulations surrounding foreign investment and tax laws for foreign investors in China. Tax incentives may be offered by the state government, the local government, the district government. And one of the key things that I want you to remember is that these tax incentives, they generally don't last forever. We have just heard that, I believe it's by the end of December 31st, 2025, Qinghai district in Shenzhen is stopping their preferential treatment of the 15% corporate income tax rate, which means that from 1st of January 2026, they are going to now move into the 25% category. So if you have strategically made a decision on a location purely for tax reasons, remember that this is not long-term, which is why it's really fundamental to do proper tax planning, in order to be able to optimize your tax situation, knowing in the back of your mind that once you are profitable in China, which might take time, when you're in the startup phase, you're not profitable. We've seen that on average, it takes between 3 to 5 years for a company to break even, not even become profitable yet. So you've got to understand whether these tax incentives really will be of an advantage to you. We've just had a client who is in Lianggang district in Shanghai. They're benefiting from a tax rebate regime that is in Lianggang. And the advantage there is that alone in 2023, they are going to be receiving a refund of approximately 90,000 RMB, which is not peanuts. It's fantastic. But I just want to reiterate, this is an advantage for now. It's not an advantage forever. Now, if you decide in a city like Shanghai that you want to change office space and move into a new district because you're growing, you're expanding, etc., you've got to understand the tax consequences. If you are based in Jing'an district and now you want to take advantage of the Lianggang district incentives and you want to move office space, you need to do a tax closure audit in Jing'an to then reopen in Lianggang. And this process alone can take anywhere between 6 to 12 weeks, depending on the efficiency of that tax bureau. So this could halt your business for that period of time where you won't be able to issue fapiaos, etc. So it could prevent you from growing and scaling for that amount of time. So please do be aware of this. I hope today's video has helped. See you soon.
If you enjoyed this episode and you'd like to help support the podcast, please share it with others, post about it on social media, or leave a rating and review. Now, can Woodburn help you? I am offering a free 30-minute call where we discuss the obstacles you are encountering on your China and/or Hong Kong business journey and how we can help accelerate your success. The link to my diary is in the show notes. I look forward to speaking with you soon.